Hello, my name is Abby Robinson, and I'm here to discuss financing the deal.
How does real estate financing work? Real estate loan types can be broken into several broad financing categories. This video is meant to help you understand 4 different types of financing available to real estate investors. Now let's discuss the options to finance your deal. Number 1, hard money. There are pros and cons to all types of financing. Let's discuss the pros and cons of hard money lending. First, the pros. Most hard money lenders are asset-based lenders, meaning they're not personally qualifying you as a borrower. This means that they aren't checking your credit score, your bank accounts, or your personal financials. Instead, they're looking at the value and potential of the asset to qualify the loan. This helps if you don't have a W-2 job. Hard money is considered cash equivalent, which means it's equally appealing to sellers as paying in cash because it means fewer hoops to jump through versus conventional financing and likely means a quick close. Most buyers that use hard money financing are able to close much quicker than conventional financing because they're qualifying the asset and don't need appraisers, which typically leads to much shorter due diligence periods. You're able to negotiate flexible terms more easily with hard money lenders versus conventional financing, such as interest-only payments during the loan period. Now for the cons. Most hard money loans are designed to be short-term, usually between 6 and 9 months. This means you must have an exit strategy in place, such as a fix and flip, a refinance, or a sale, with a structured timeline in order to pay back the lender. Hard money comes with high interest rates, normally between 12 and 15%, along with higher fees than traditional financing. Number 2, conventional financing. Some investors elect to stick with conventional financing, especially if they are bankable, meaning they have a strong W-2 job, credit score, and personal financials. The pros for conventional financing are longer terms. Most conventional lenders offer terms that are amortized up to 30 years, allowing for lower monthly payments. This comes along with lower interest rates, depending on the market, which can sometimes lead to lower fees. Cons. Most banks are not going to lend on a distressed property, even if your plan is to rehab it. They typically won't finance that rehab either. There is a slower closing process as due diligence, inspections, and appraisals are required. Banks also require principal and interest payments, along with a 20% down payment on the loan. This means more upfront costs for the buyer. Number 3, private money. Another financing option is private money. Some of the advantages for private money are that this is typically asset-based lending, although the experience of the operator in the deal carries a lot of weight with private money lenders. Private money allows for the borrower to have access to quicker cash to close the deal. There are also fewer lending requirements depending on the type of raise. However, some raises require you to vet accredited investors. Some cons include the following. You'll likely have to offer a higher interest rate to private money lenders, as well as some equity in the deal. It's also very difficult to get started in finding private money lenders and raising capital, especially when you're a new real estate investor. Because you're selling securities in your deal, you're required to file SEC paperwork, which can lead to costly attorney's fees. Number 4, subject to financing. Buying a property subject to means the buyer essentially takes over the seller's remaining mortgage balance without making it official with the lender. It's a popular strategy among real estate investors, especially when interest rates rise. Some pros for sub-to financing are the following. This option can lead to a quick sale, as it's only a contract agreement. Also, sellers are sometimes in distressed positions, allowing for the buyer to move swiftly. An additional benefit is that there are no down payment or fees unless specifically negotiated. Buyers can usually obtain a better interest rate in these situations, and it allows for the seller to build credit while the buyer pays down their mortgage for them. Some disadvantages of sub-to financing. Technically, if the lender finds out about the sub-to contract, they can call the loan due via a due on sale clause. Another disadvantage is that, as a buyer, you're likely taking over a very distressed property, making it a riskier project. Finally, there could be insurance issues that arise if proper coverage is not updated by the buyer. That's all for this week's episode. Good luck financing your next deal.